Hello, and thanks for watching the ETF show. Joining us now is Joe Haag, client portfolio manager with the fixed income team at Neuberger Berman. Well, Joe, it's great to have you with us. First, could you talk about Neuberger's expectations for the fixed income market over the next 6 to 12 months? And where are you seeing opportunities, and what do you see as the most underappreciated risk?
Sure. No, thank you, Janet. Appreciate you having us. Neuberger's fixed income outlook over the next 6 to 12 months is we still expect positive growth. So we're not calling for a recession, haven't called for a recession all cycle. But the growth is likely to be somewhat muted at around, call it 1.25%. In terms of big picture, inflation, we do think that the tariff impact has kind of extended elevated inflation. And so, we don't think we're going to get much improvement in calendar year 2025 over 2024, which ended around, core CPI was around 3.2%. We do think that as we get into the second half of 26, though, and the one-time impact of tariff inflation has taken course, we think that it'll likely begin to trend down towards the 2%, maybe not get to 2%. It'll probably take some time for that. In terms of the Fed, we do expect 2 cuts this year and 2 in the first half of 26. So 4 over the next 12 months, I'd say. And we think that the neutral rate for the Fed funds rate is in that 3.25 to 3.75 range. In terms of opportunities, given that outlook of positive growth and Fed cuts, we see the front end of the U.S. yield curve is very attractive. So some of the strategies that we recommend, kind of focus on that area. In terms of risk, it would really be the other side of that, right? The longer end of the yield curve. Today we're hearing a lot about, the Fed in terms of the administration, the back and forth with the administration. These are headline risks, right? But we also, moreover, given the amount of debt that needs to come to market, whether it be the plus or minus 9 trillion over the next 12 months that needs to get refinanced, or the just under 2 trillion in expected budget deficits. That's a lot of debt that's going to come to market. So we do think there could be volatility at the long end, which could have the impact, the effect of destabilizing riskier assets, whether it be credit spreads or equities.
Joe, you engage with advisors on a daily basis. What are some of the biggest challenges that they're raising right now?
Yeah, I think the overarching theme from advisors is they understand that risk assets, valuations are quite high. I mean, whether you're looking at tight credit spreads or elevated equity valuations. And so I think one of the things that they've expressed most is how to responsibly take down risk in overall allocations. Specific to fixed income, we get a lot of clients focus quite a bit on 2022. In that case, what I try to talk to advisors about, and really speaking to the clients, really framing the objective, like the purpose of the fixed income allocation to the overall allocation, and really try to distinguish between an equity recessionary drawdown and an inflationary equity drawdown. We think given the increases in rates that we've seen over the last couple of years, we think you're unlikely to get another inflationary equity drawdown. And we know that is when that impacts fixed income disproportionately, arguably more than equities. If the next phase of the cycle is a more recessionary equity drawdown, that's really where the fixed income provides that ballast, or that offset to equity volatility. And we think that's likely going to be the next phase, although we're not expecting a deep, prolonged recession. But given the role of fixed income and allocation, that's really where we try to get clients to focus.
Now, can you talk about some of the strategies Neuberger offers to help them with these challenges?
Yeah, sure. I mean, so Neuberger, we employ a relative value investment process. And so what I would say is to break our platform down into 2 sub-platforms, if you will. One would be benchmark aware strategies, and this other subset would be benchmark agnostic strategies. And so depending upon the objective, what type of risk model the advisor is looking to build, the benchmark aware strategies, front and center in today's market, We offer a core bond strategy that, has a 20 plus year history. One of the best actively managed bond funds out there, top quartile, again, going out 20 plus years. And then a newer addition to our 40 Act platform, which is a total return strategy, which has a wider universe, higher tracking error. And so the ticker on that's an actively managed ETF, NBTR. And then moving to our benchmark agnostic platform, these are actively managed best ideas strategies that really target a risk return profile. And so really objective driven. And so on the front end of the curve, we have a short duration income fund. That strategy, seeks to generate a high level of efficient income at the front of the curve. And when we say efficient income, we mean primarily focused on investment grade credit. Moving out on the risk return, our flagship strategic income fund, the objective there is maximize total return within an investment grade risk profile. And then further out of the curve, we have a flex credit ETF, also a new launch, NBFC. That strategy seeks to enhance the return profile of high yield. So similar returns with a higher Sharpe ratio would be really what we're seeking in that strategy. And so depending upon what the advisor is trying to do, any one of those strategies in today's world, we think fits in nicely.
Finally, Joe, how would a fixed income allocation change based on client objectives?
That's really the key, right? I mean, the key is the client objective, what the fixed income allocation means to the overall portfolio. And so if it's meant to provide ballast or offset to equity volatility, you want to make sure that you have a good portion, maintain the integrity of that objective in high quality investment grade fixed income. Now, if the advisor is concerned or the investor is concerned about rising interest rates, it's absolutely fine to add a strategy to a core bond or a core plus type strategy that'll bring down the overall interest rate exposure. And that's where maybe like our short duration income strategy could come in. Our strategic income strategy will, play an active role in moving, some of the risk around based on where we see relative value. On the other hand, if the allocation is really meant more to provide income, right, more of a total return approach, as long as the advisor understands that the allocation there is going to have a higher correlation to equities, if your objective is to take down risk, you could certainly use any of the other strategies that we discussed. But that's where, in our world, the flex credit strategy would probably, be able to play a bigger role. And so in the case if you're trying to take down risk, maybe carve off a little bit of your equity exposure and allocate it to the flex credit strategy. So again, it's going to have a higher correlation to equities. It's got about a 7% gross yield to worst today, which is generally a good approximation of what your 4 to 5 year annualized return is going to be. So, that's a way of getting your income up and taking some equity risk down. But, it does, to your point though, it does matter what the objective of the allocation is, how you tweak it. But you want to maintain the integrity of the initial allocation, just tweak around the edges in terms of, imparting your views.
Well, Joe, thank you so much for being with us today, and thank you to everyone out there watching. Once again, that was Joe Haag, Client Portfolio Manager with the Fixed Income Team at Neuberger Berman, and I'm your host, Jenna Dagenhart, with Asset TV.